So in this video, I wanted to talk about why I love trading earnings, or I love selling options when it comes to earning announcements, and specifically selling puts. So I wanted to talk about a trade I made this week on Zoom. So as you can see, Zoom had earnings Tuesday after hours. So after the close, Zoom was going to announce earnings. So one thing you have to know about earnings is because there's uncertainty, people don't know what's gonna be announced in earnings. So there's uncertainty, so that means the premiums of the options are overstated. There's volatility in them, extra volatility. So if anything's expensive, it makes sense that you want to sell what's expensive. So I like to sell options. Now, if I look at the Zoom chart, now the way I like to play earnings is by selling a put or selling a put spread. I am not guessing direction. In fact, I have no idea where the stock will go. But just from experience, I've realized that the put side wins more often. So I like to sell an out-of-the-money put or out-of-the-money put spread. So if Zoom was announcing earnings Tuesday after the close, so June 1st after the close, I want to sell my option before Tuesday close. So that Wednesday, once the market reopens, ideally I can try to close the trade. So on Tuesday, if we look at Tuesday, June 1st, you can see Zoom was trading it opened at 335. It went all the way down to 321 and then came back at around 328. So around this price here, so when it was trading at around 325, if I go to my orders executed, filter on Zoom, you could see that June 1st, 1035, I sold the 300 put on Zoom for $4. So I did one contract, so that's $400 that comes into my account. So June 4th expiry, 300 put. So what does that mean? That means that all I need is for Zoom to stay above the 300 strike, the $300 mark, by expiry of June 4th. Right now we are June 3rd and Zoom is trading at around 318. Now, what happened after earnings, when earnings was announced, which was June 1st after hours, the stock didn't move much. It ended up flat, and then the next day, so you could see June 2nd, so this area over here, you could see that it was trading at around 331. It went all the way down to 322, came back up again to 327. So it was pretty much the same price as the day before earnings was announced. So it was pretty much flat. So because of that, I was able to put option that I sold for 300. I was able to buy it back for 50 cents. The next day, so from June 1st to June 2nd. So that gives me a $350 profit. And what I like about this trade is I didn't even require anything from the stock. I didn't even need the stock to move, and I was still able to make a profit from this trade. It could have been flat, it could have gone up, it could have even dropped a little bit. As long as it doesn't drop below 300, then I can profit on this trade. So that's mainly, or that's a big reason why I like selling options, is because I'm not requiring much from the stock and I could still profit. So why do I sell a put? I just always sell a put. I don't try to pick direction. I just decide to always sell a put because I know I'm not good at picking directions, but I know I'm going to be right more than 50% of the time if I always sell puts. And anyways, I don't even sell puts at the money. I sell them out of the money. So I give myself room for the stock to drop a little bit. It can go from 328 or 330 to 300 and I could still win. Now, what would have happened if it had dropped to 275, for example, which is possible. With earnings, it could go either way and it could move a lot. Anything's possible with earnings. So you always have to keep that in mind. In fact, before I get into any trade, I make sure that am I able to handle worst case scenario. If the stock did end up dropping to 275 after earnings, can I afford it? Can I manage it? What's my exit plan? So before I enter a trade, I make sure that I have a plan. And my plan in this case was I would have to roll it. I would have to roll my Zoom option the same way that I'm rolling my Spotify put option here. Spotify was an earnings trade. Spotify was trading at 290. I sold the 260 put and the stock kept dropping all the way down to 215. And now I've rolled it to 250. So now I'm just waiting for the stock to come back up. And if it doesn't, I'm going to have to roll it again. But every time I roll it, I roll for a credit. So if we look at Spotify chart here quickly, you can see how crazy it dropped. So if we look at the 1 month chart, right around here, look at this. The stock was at 290. It dropped all the way down to 260 and then kept dropping all the way down to 215. So that's one of those worst case scenarios. It happened to me on Spotify, and I was ready for it if it happened on Zoom. So that's why I had confidence to take the trade. So I took it, and luckily I was lucky. This was no prediction. It totally paid out, because in exactly the next day I was able to close the trade for a $350 profit. Now, why did I pick the 300 strike? I just simply like to go at expected move. So I look at to get the expected move, I look at the straddle value. So the straddle value when Zoom was trading on Monday or on Tuesday was around 25 points. So that brought me to the 300 strike. Right now you can see that the expected move is about $5. It's obviously earnings has been announced. There's no more volatility. Plus there's 1 day left to expiry. So there's a big difference between 4 days left before earnings and then 1 day left to expiry, and there's no more earnings. So big difference, big drop in the volatility, in the expected move. Now, what's the capital required for this trade? I'm going to bring up my buying power calculator here. I have it in my trade log spreadsheet. So if I go to buying power, Zoom is a 30% margin requirement stock. Where do I get that information? So if I look up the stock here, Zoom under quotes, long MR. So it's a 30% margin requirement stock. So if I go back to my buying power calculator, so 30%. And the stock was, market price of the stock was trading at around 328 when I sold the put, and I sold the 300 strike. So the capital required for that put was $7,000. But the problem is, if the stock, let's say I'm lucky because the stock ended up opening at the same price, but what if the stock dropped all the way down to 275, let's say? Then the buying power increases to $10,000. So that's what I had to make sure of before entering the trade. Can I afford to hold this trade and wait for the stock to recover before entering the trade? Otherwise, I would not have taken the trade. I would have probably done a put spread instead. The other thing I checked quickly is just the overall chart. I saw that Zoom was at some point close to $600. I mean, and in the past year, it dropped a lot, almost 50%. So that gave me confidence to take a naked put. Plus, I use the product every day and I love it. Makes a lot of sense to me, and I think it does have a competitive edge. It's so much faster and so much easier to use. So that gave me the confidence to enter a naked put. But if the stock was trading around here at 538, I would not have done a naked put at this point. Because imagine if the stock dropped on you and you're trying to recover and roll it, it would have been disastrous, because it might never recover to $500 again. So if I see an exaggerated chart like this, I'm not going to sell a naked put at all-time highs. But I sold a naked put because the stock did drop a lot. So that gave me a little bit of confidence. What I also like about this trade is that I was in and out in 1 day. So I didn't have to deal with the general market craziness that's going on these days. Just a quick in and out, $350. And the reason why I don't try to predict direction for earnings, because as you can see, Zoom has beat earnings for the past, 5 earnings, and the stock has dropped a lot even after earnings. So it has completely no relation or no correlation with if they beat earnings or not. So that's why I don't try to guess direction. I just always sell the put side and make sure that I'm okay handling worst case scenario. So you can see right now that put is actually worth 15 cents. So I bought it back for 50 cents, 50. Right now it's worth 15 cents. But I don't feel bad, of course, because I'm not going to hold on to the trade an extra 3 days just to save 50 cents. For me, going from $4 to 50 cents is definitely a good deal. I definitely don't regret closing it, and because I know anything can happen. I mean, Zoom can still drop below 300 by Friday, and it would be a big regret if I didn't close it. So this is what I was preparing for. Worst case scenario, let's say stock goes to 275. The 300 put that I sold at expiry will be worth $25 for me to buy it back. If I buy it back for $25, I sold it for $4, my loss would be $21. That's assuming that I don't roll it, I just close it and take the loss. But if I roll it, I could roll for a credit, but it's going to take much more capital requirement for me to hold on to the trade. I'll go from 7,000 to 10,000 of maintenance excess. So this is what happened. June 1st, I sold a 300 put for $4. Expiry June 4th. I did one contract, so that times 100, that gives me $400. To win, Zoom needs to stay above 300 by June 4th. The capital required when I opened the trade was $7,000. And then on June 2nd, the next day, Zoom was around the same price. That same put was now worth 50 cents, so I bought it back to close the trade. That's a profit of $350. So what is a put option? A put option is a contract giving the owner the right, but not the obligation, to sell a specified amount of an underlying security at a predetermined price within a specified time frame. So that 300 put, I sold it, I didn't buy it, but the person who bought the 300 put, it gives them the right to sell 100 shares of Zoom at a $300 price. That's what the buyer of the put option, that's their right. It's not an obligation, but that's the right of someone who buys the 300 put. They paid $4 and it gives them the right to sell 100 shares of Zoom for $300. Now, I sold the put. So I just sold the put, I collected the premium, but what the situation that it puts me in is the buyer of the option could exercise their right of selling the shares. So if they sell the shares, someone has to buy them. So I'm going to end up buying them because I'm the one who sold the put option. So so the worst case scenario is I would end up with 100 shares of Zoom if at expiry the put option is in the money, which means the stock is below 300. So that's the risk with selling puts. But of course, I can roll it before getting assigned. But luckily, in this situation, the stock ended up flat and the premium dropped in value, and I was able to close the trade completely. So I'm no longer in this position. So I just wanted to give you an example, a good example. I think this was probably one of the best examples of why selling options is amazing, especially during earnings. You don't need anything from the stock. You don't need the stock to go up like crazy or go down like crazy, and you could still make money. Seems pretty simple as long as you know the risks involved. So yeah, just want to share it with you. If you have any questions, leave in the comment section below. Like always, if you want to open an account with Questrade to trade on the stock market or sell options, use my referral link below to get $50 in free commissions. Also check out the other referral links below. If you enjoyed this video, click the like button, share with a friend that might be interested in this, and subscribe to the channel. Thanks for watching.